영상 내용은 출연자 개인 견해이며 어떠한 투자 조언, 자문 권유가 아니므로 참고용으로만 봐주세요.
By the way, when an ETF gets liquidated, the assets are just returned to the shareholder. We've had people ask us that question in the past. Factor really would be a lack of investor interest, and you would see that in AUM, right? If there's no assets in a fund, it's telling you nobody wants the fund, so why continue to keep it open? And when you look, when you think about the family of YieldMax, to date, there have been no closures of any of the YieldMax funds. I think that's kind of incredible. We've got over, I think it's 52, 53 live funds at this point, and none of them have been liquidated, any of them. So, but it really is a business decision more than anything else. Now, I do think in the case of YieldMax, there is this one little added thing. If the underlying company gets delisted, right? As we remember with SMCI, was that even a year ago at this point? Where there was a chance they got delisted because they didn't make their filings right properly on the NASDAQ. At that point, there's no fund right? The fund can't invest in specifically SMCI. So in addition to business decision, there can be a situation where specific to that individual fund, if the underlying, ticker was to stop being listed and there were no options or it didn't trade any longer, well, then that situation, the fund would get liquidated as well.
The reason people have that impression, though, is that oftentimes when publicly traded companies are issuing new shares to raise capital, that can be dilutive for them, especially if and as they do those things at dilutive prices. So if a secondary gets priced at a level where the amount of money flowing into the company is not commensurate with the value that you own your shares at, that is indeed dilutive. If a company does something called a PIPE, which is a private investment into a public equity, where they offer some institutional investor the ability to buy some block of it for a big discount, that is dilutive. But in an ETF, it doesn't work that way. Money in, money out, it's pretty straightforward. And let me give you a simple example. You have a fund with 100,000 shares in it and $1 million. So each share is $10. And the creation units are 20,000 shares. Well, if you have a creation unit take place, so there's 20,000 new shares, now there's 120,000 shares, that's going to be accompanied by an investment in the fund of $10 per share. So now the value of the fund is 1.2 million. Well, 1.2 million divided by 120,000 is still $10 a share. And if somebody redeems a 20,000 lot, the exact same thing will happen. The share count will decline. The assets will decline by the net asset value per share, up and down. So it does not make any difference. There is some operational aspects that have to take place when new funds come in. Those funds end up getting deployed pro rata or otherwise, but it is not dilutive. When you start closing on $100 billion, you're not small cap, you're not mid cap, you are a large cap company by this point. And I would add something else, which is that an underlying that trades on average about 550,000 contracts per day, 5.5 million shares worth, 5.5 million shares, by the way, of a $330 stock. What that is telling you is that there is more turnover notionally in the options value for MicroStrategy than the entire value of what we would call a small cap company. Right? It's 2.75 million open interest. It's a very active issue. And the other thing is that, YieldMax specifically and Tidal more broadly, they're keeping an eye on the liquidity of the market. We've seen recommendations. People will lob in an email, how come you don't have a fund on this stock or that one? It's because these are important considerations. Is there a sufficiently tight market, a sufficiently liquid market? Relationship between the stock price and its respective strike price is tight enough that you can identify a good strike to sell relative to the current stock price. Very low price stocks that can be challenged. This is a high price stock. It's over $300 a share. So yeah, that's not an issue in this. This is actually one of the deeper options market stocks there is. Yeah, the first set of criteria that are being described in this question are, one way to think about that is these are qualifications, right? So in order to launch a fund, the underlying security and its options chain would need to have certain qualities that are going to make it suitable. And those qualities are going to include sufficient liquidity in the underlying stock and its options chain, sufficiently tight bid-ask spreads, presumably a decent amount of open interest, and a good relationship between the available strikes and the stock price, which is dictated more by the stock price itself than necessarily the options market, because you can actually ask options market participants to list additional strikes if those are needed. With respect to the second part, that really is about investor appetite. There's no sense launching a fund that nobody wants. Thematic considerations and macro trends are going to be important. We're going to be looking at things inside of that space. Sometimes it's going to be on companies that we know have very long, good operating track records. In other cases, it's going to involve stocks that there's clearly significant investor demand. And actually, to that end, there are two new funds that were launched this week. Gamey and Ready, which is Ready is on Reddit. Gamey's on GameStop. And YieldMax ETFs, in many cases, can give them something that's hard to execute on your own. If you like MicroStrategy and you like the idea of selling covered calls against it, but you recognize that you're not going to be trading this thing every day, you need somebody else to manage that. But if you have no view at all, and it's the strategy that you're most interested in, but you don't have a really strong view on any underlying security, that's when you would pick a product like Alti. And Alti, of course, is going to have a prevailing bullish view on the market. How you choose has a lot to do with whether you have a strong view on any given underlying asset. But the thing that all of these strategies share in common is a belief in selling options to generate income. So that's really, I think, the way to think about it. Jay?
Yeah, it's income first, right? The name YieldMax suggests, distributions are our priority. And then, but having an idea of having a thesis on the underlying stock is obviously important. But, quite often some people look at a covered call strategy like YieldMax and be like, well, it underperformed the underlying stock. And we would say, yep, that's almost always going to happen because it's not about upside capture. The reason we're selling calls is we're exchanging upside for current income, right? For the premium from the options. And so that should be your first, decision criteria that you're looking for the distributions and the yield. About having your bias on, you want the bullish side or the bearish side, like those are, all things that you should consider. I will add in one piece as an advisor in my previous life. I would tell you that stock risk leans more on the higher end of the risk profile. And then when you look at tickers like Tesla or Coin or like BABA, right? These are higher volatility stocks. So higher volatility adds another level of risk. Yes, it gets muted by the fact that we're generating cash, as Mike alluded to before. But what I would also tell you is realize when you're playing in the YieldMax in space, you're probably in the more volatile side of the equity asset class, right? So Alti, typically we told you the thing we look for first, we go find the most volatile stocks we could find. Okay, so you have to digest that when you're making this decision about risk and reward. You have to have the risk appetite for that. If you are looking for a smoother type of a product, use some of the index-based YieldMaxes, right? So there's an S&P 0DTE YieldMax product you can look to. Or if you like single stock, pick JP Morgan or Disney. By the way, those stocks have plenty of movement in them, right? You could still get a pop of plus 5% in any day or minus 5% in any day in those single names. So, again, to me, it's always risk first. Risk is what you should decide. And does this fit into that category for you of the underlying tickers that you picked? You have to be comfortable with the risk. Once you do that, then you go out and you can pick the tickers that you like. as Mike said, right? We just launched GameStop, GMEY, and Reddit, RDYY today. Those can have some level of volatility with them. Let's face it.
Or, I will add one quick thing here, and that is that for investors who are looking at these who have never traded options themselves, are less familiar with the strategies, they probably are familiar with the concept of beta. So beta just talks about the relationship of a stock's movements relative to the broader index. Stocks with a beta greater than 1 are going to tend to move more. Markets, you have a beta of 2, the market's up 1%, your stock might be up 2%. If it goes down 1%, it might be down 2. It might be down 3. It might be down 5. So the stocks that exhibit more volatility will have more expensive options. And the stocks that have lower volatility, the options will be less expensive. And so the yield capture will be commensurately less, but the value of the underlying asset will also move less. And you can see on the single stock ETFs, the beta is a number that's published for almost every stock. You are the type like Roaring Kitty who made GameStop famous, then you should be expecting things to move around a lot. That's what that one. If you are, if you're interested in more information, whether it is about the distributions, whether it's even about the positions, or whether it's even about the trades, you can find that on the YieldMax website, and you can subscribe to the newsletter, and you'll get those updates. And this stuff is, one of the nice things about ETFs is that they are a transparent investment vehicle, more transparent than some other wrappers can be, which only have to publish quarterly. The positions in these funds is updated every night. So if you want to know what's in there, all you have to do is look.